Assalamu alaikum, dear students. So let's start our lecture. So today our lecture is regarding to the commercial papers. In our previous lecture we discussed the T-bills in details, but one of students, they asked me a question that, sir, what is the difference between T-bill, T-notes and T-bonds? You not discuss the differences of these. Either these three are same or not. So before going to discuss the commercial bank, I will try to shortly and easily explain the difference between T-bills, T-notes and T-bonds. T-bills, dear students, T-notes and T-bonds, treasury bills, treasury notes and treasury bonds, that are, as you know, that fixed income investment that is issued by the government, the Department of the Treasury. When the government needs to borrow money, so they are all commonly referred to as a treasury. Means that these are those sources through which governments they are generating funds for the budget deficits. T-bills or treasury bills, they have maturities, as we discussed in the detail, up to 1 year or less than 1 year, but maximum is up to 1 year, and mostly they do not pay interest before the expiry of the maturity date. They are sold out in the auctions at the discount price from the par value. They are offered with the maturity of 28 days, 1 month, up to 3 months, 90 days, 91 days, to 6 months, 180 or 182 days, or to 365 days, 1 year. There are different, they have different maturity. Now T-notes. T-notes are treasury notes. Keep your mind. Treasury notes have a maturity periods of 2 to 10 years. T-notes. They came in denomination of 1,000 and offer coupon payments every 6 months. The 10-year T-notes is the most frequently quoted treasury when assessing the performance of the bond market. It is also used to show the market's take on macroeconomics expectations. T-bonds. T-notes is also like, this is also a bond which is issued by the governments to generate funds for themselves, and their maturity is up to 10 years, long terms. T-bonds, treasury bonds, having a longest maturity among the 3 treasuries. They have maturity period of between 20 to 30 years with coupon payments every 6 months. T-bonds, they are offering mostly suspended for the 4 years between 2004 and in 2006 as well as. Why this offering is resumed? Due to demand from the pension funds and other long-term institutional investments. So look at the main difference between T-bill, T-notes and T-bond is the time period. All these three only and only that is issued by government. What is their main purpose? The main purpose of these three instruments is to generate funds by the governments to compensate the budget deficits. But T-bill is a money market instrument. Why? Because their time period, maturity time period is 1 or less than 1 year. While these two, T-notes and T-bonds, these are such type of the debts instruments which have maturity more than 1 year. So these are the capital market instrument. You will discuss capital market in upcoming classes in details. But here I will give you a short definition of the capital market, that capital market is a market where long-term securities whose maturity is more than 1 year that are trading, such market is called capital market. So the T-notes maturity, maximum maturity is up to 10 years and the T-bonds, treasury bonds, maturity is up to 30 to 40 years. So all these three are the debts instruments which is issued by government to generate funds, number one. Number two, these are debts instruments. Number three, that are issued by government to generate finance, and the difference between these three are the time period, their maturities. So hope now you will understand the difference between T-bills, T-notes and T-bonds. Now our new topic is commercial papers. Look at, dear students, commercial paper is also a debts instruments. This is a money market instrument or money market securities. Money market security means commercial papers also have maturity less than 1 year. 1 or less than 1 year. So commercial paper, that's why this is called money market security, not capital market security. If their maturity was more than 1 year, so then that will be called capital market securities. So commercial papers, that is money market security which is issued or sold by large corporations to obtain or to get funds to meet the short terms debts obligation or short terms funds requirements. For example, the payroll. Short terms requirements for the corporation is what's like purchasing of the raw materials, paying of the salaries, paying of the repair and maintenance. So, and that is backed by only either by the issuing bank, those bank who issue it. So they are promising of the backed up. Backed up means to returns back the face value, or promise, or that company promises who issued it to pay the face value amount on the maturity date. specified on this commercial papers. Commercial papers, dear students, as compared to T-bills, they are risky and unsecured. Why? That in the promissory notes or in the T-bills, etc., the fixed rates, discount rates they are offering. So it is typically issued by large banks or corporation, the commercial papers. So they to cover their short terms receivables and meet short terms financial obligations such as funding for the new projects and so on. So commercial papers, dear students, is an unsecured short-term debt instrument, keep in mind, that is issued by a company generally for the facing of the account receivables, inventories and meeting the short-term liabilities. Commercial papers is usually issued at a discount rate from the face value and they are reflecting the prevailing market interest rate. Commercial papers, dear students, is not usually backed up by any form of collaterals, making it a form of unsecured debts. So as a result, only the firm with high quality debts rating will easily find buyers without having to offer a substantial discount or higher cost for the debts issues. Because commercial paper is issued by large institutions, so the denominations of the commercial papers offerings are substantial. Other corporations and financial institutions, wealthy individuals and money market funds are usually the buyers and also of the commercial papers. Look at here, those companies whose rating are too much high, means their record are high. So when they issue these commercial papers, the investors will make investment, but the non are not good rating company, when they issue the commercial papers, so investors not have trust on it and will not make investment as compared to the high rating company. So these is commercial papers, they are not backed up by any kind of assets. Similarly, they are not transferable and held till maturity. Ownership is not transferable. When anybody they purchase it, so they will keep those commercial papers till its maturity, and their maturity is maximum up to 9 months to 70 days. But yes, we also have the 3 months commercial paper, the 6 months and the 9 months commercial papers. And the performance, the discount rate, that depends upon the performance of the company. Those company who are well performed and they are issuing the commercial paper, so they are giving less discount rate. And as compared to those companies whose performance is not very good, so the risk is too much high, that's why they are giving high discounts. Mostly the commercial paper, just like the T-bills, they are issuing on the discount by the corporations, but the major difference between this is commercial paper is issued by corporations and T-bills is issued by governments. Mostly, that is commercial paper used to meet immediate cash need of the firms, and mostly that funds that is generated from the commercial papers, so that are used in the current transaction. The questions come in the mind that why the corporations they issued the commercial papers. Yeah, we can say that what is the advantages of or benefits of the commercial papers. So major benefits of commercial paper is that it does not need to be registered with the Security and Exchange Commission SEC as long as it matures before 9 months, or we can say that, dear students, to 70 days. So making it a very cost effective means of financing, although maturities can go as long as to 270 days before coming under the preview of the Security and Exchange Commission. So maturity for the commercial paper average about 30 days. Rarely that are reaching to that. So the proceed, dear students, from this type of financing can only be used on the current assets or inventories and are not allowed to be used on the fixed assets such as new plants without the Security and Exchange Commission involvement. Means that the commercial papers, the funds that is generated from the commercial papers, so company must use that within their working capitals, not in the capital budgets. The commercial papers market play a big role in the financial crisis. If you remember, that is begins in the 2007. As investor begins to doubt the financial health and liquidity, so the commercial papers market they play a vital role in that crisis. Like a commercial T-bills, commercial paper returns can be calculated with the following formula. So par value minus purchasing price divided by par value multiplied by 360 divided by days to maturities. Days to maturities here means that if this is the 3 months commercial paper, so 360 divided by 90, because in 1 month we will consider 30 days. Clear? Or if that is the 6 month, so 360 divided by 180. As we discussed that commercial papers that is purchased on the discount price. So look at par value. Par value, let's suppose the commercial paper is 1000 and discount or purchasing price is 950. So 1000 minus 950 divided by par value 1000 multiplied by 360 divided by f, that is the 3 months, so divided by 90. In this way we can find out the returns on the commercial papers. So through by this formula we can calculate the returns of a commercial paper. So dear student, hope you will understand that what does it mean by commercial papers? So commercial paper, that is debts instrument, debt security which is issued by large corporation to generate the funds when they need. And this is money market instrument. Money market instrument means that their maturity is up to 9 months, less than 1 year. Mostly the money that is generated through by the commercial paper, so corporation are bound that they spend that money on the current asset, not on the fixed assets. The commercial papers that are issued on the discount rate with the face value, clear, and mostly this is a short terms investments. This is unsecure as compared to T-bills, and formula to returns to calculate returns on the commercial paper, this is same like the T-bills, that the par value of the commercial paper minus purchasing price divided by par value multiplied by 360 divided by days to maturity. So in this way we can calculate the returns on the commercial papers, or we can say that yields of the commercial papers. So dear student, hope you will understand the commercial papers, and if you have any questions, so you can freely ask me in the WhatsApp group. The next topic, that is certificates of the deposits and negotiables, CDs. So we will discuss inshallah in our upcoming lectures. For now I will take the permissions of the leaving the class. So remember me in your prayers. Allah Hafiz, have a good time, see you inshallah.